Okay guys, so Bill Wang lost 20 billion in 2 days. And I'm going to show you how I'm going to take advantage of that. Guys, this video is sponsored by FX Choice. Don't forget to thumbs up, comment, and subscribe, and go check them out. Tencent Music, what is it? It is literally the equivalent of Spotify, except for it's in China. So the market there is very, very tight, and it's hard for a US company to go into that market. So what happened was Tencent Music was created in collaboration with Spotify. So Spotify own 8.5% of Tencent Music. So Tencent Music has been on a complete rally. It's rallied all the way from $14.50 all the way up to around 31. This is a huge move for a stock in such a short space of time, from around October 2020 all the way up until March 2021. Then what you'll see is on the chart, you'll see that the shares plummeted by 40–50% in the space of 2 to 3 days. So what happened?
Bill Hwang built a fortune, then lost it in 2 days. The fast rise and even faster fall of a trader who bet big with borrowed money. Bill Hwang was the greatest trader you'd never heard of. Starting in 2013, he parlayed more than $200 million left over from his shuttered hedge fund into a mind-boggling fortune by betting on stocks. Had he folded his hand in early March and cashed in, Hwang, 57, would have stood out among the world's billionaires. There are richer men and women, of course, but their money is mostly tied up in businesses, real estate, complex investments, sports teams, and artwork. Hwang's $20 billion net worth was almost as liquid as a government stimulus check. And then, in 2 short days, it was gone. The sudden implosion of Hwang's Archegos Capital Management in late March is one of the most spectacular failures in modern financial history. No individual has lost so much money so quickly. That's why on Friday, March 26th, when investors around the world learned that a company called Archegos had defaulted on loans used to build a staggering $100 billion portfolio, the first question was, who on earth is Bill Hwang?
So let's explain this in simple steps of what happened. Bill Wang, hedge fund manager from Archegos Capital, he used derivatives in order to buy the underlying asset of shares with 20 billion, okay? So he didn't physically own the shares, but he would be able to make money, gains or losses from the volatility of the up and down of the underlying asset, in this case, multiple stocks. So using derivatives and swaps, he managed to be able to use 20 billion in capital and leverage that money up to be 100 billion in value in the markets. Well, with that comes interest rates on the swaps, paying back the interest. And basically what happened was the biggest collapse we've ever seen in history, where a hedge fund manager overexposed themselves with too much leverage, and it forced the banks and the underlying asset holder to basically close all of the positions. They had to liquidate because he was getting margin called. So in short, Bill Wang got margin called. What does that mean? That means that the banks have to close all of the positions that they have from Bill Wang in order to protect themselves because they're getting margin called. What this does, it means that they have to do block trades, where they do a transaction on a share or any instrument really, and it's outside of market hours, okay? So they privately negotiate the trade. This caused a massive after effect in the markets when the markets opened, as there was a large sell-off in multiple shares. The first one, I believe, was Viacom, where we saw the share price completely spiral downwards. And then as the prime brokers started to offset all the other positions, we saw an aftermath in the markets. So we have a quick view here of some of the aftermath of what's been going on with all of these shares dropping.
This is a catastrophic failure of risk management 101. That's exactly what the risk managers are supposed to avoid. Look at what happened in the market. What if you were holding Viacom on Friday and the stock traded down from 66 on Thursday afternoon to 48 on Friday morning? That's serious collateral damage, and the onus for that is on the prime brokers.
How Archegos was able to amass such leverage without disclosure that was more rigorous at the very least. You're seeing the bank stocks react directly to this issue. You are seeing some of the biggest international banks exposed to hundreds of millions, if not billions of dollars worth of losses.
So this means that Tencent Music was a victim pretty much of Bill Wang's over-leveraged positions, leveraging 20 billion into 100 billion, and then the underlying prime brokers that were seeing the margin call had to close these positions out, causing a large sell-off in these shares. Now, there's nothing actually physically affecting the shares, as in there was no news from the company, there was no negatives on the company. So for me, this is an opportunity. So you can find this opportunity on FX Choice, which is the sponsored broker for this video. You can trade Tencent Music on FX Choice as well. And that's exactly what I'm going to be walking you through in this video how to do. Why would I buy Tencent? Point one is that I like to buy stocks that are discounted. Well, how do I work out when a stock is discounted? A method created by Benjamin Graham is called Intrinsic Value. It works out what the book value is of the company, and in some cases what people call fair value, what it should be priced at, in comparison to what the stock market is actually pricing the share at, which can involve emotions, fear, greed, and other factors that traders aren't maybe thinking on the spot. So I like to be able to grab them at discount. So the share is down. The actual book value is saying that it's roughly 35% higher from where we are right now. To me, that means I'm buying this stock on a 30% discount, and that sounds great. We love buying things on discount. So that ticks the box on number one on comparison to its actual book value. Number two, the share price was affected by an external factor that had nothing to do with the fundamentals of the business. This means that actually the shares were trading at over $30 that are now trading at $17. When we look at that, nothing has changed fundamentally with the revenue projections, the earning projections, its growth, so on and so forth. So it was an external factor that has affected the stock. That to me means that there's actually no reason why I wouldn't buy this company now when it was already priced at 30. Point three. So when a share price drops this much, and you see the company come out, they've announced that they're looking at doing a $1 billion share buyback over the next 12 months. That just shows you the sheer confidence that the overall senior team have within the stock. That gives us investors a very reassuring boost in why we should be buying and holding this stock for the long run. $1 billion isn't a small amount, especially for them to put behind their company on a share buyback. So if they're spending $1 billion, I'm involved. Number four, and probably one of the most reassuring points, is at this moment in time, there's 15 broker ratings from the likes of UBS, Credit Suisse, so on and so forth. Now, the medium-term projection forecast for Tencent Music is roughly $32. So not only are we moving in line with the big banks and the brokers such as UBS and Credit Suisse and Goldman Sachs, that's the medium projection is at 32, with a high-end projection of looking at 36. So with all of this taken into account, I'm buying a stock that was affected by an external factor, nothing to do with the company, which is fantastic. Two, a company that is that confident in their results and in their performance that they're doing a $1 billion share buyback. Also, all of the brokers and the main banks such as UBS, Goldman Sachs, so on and so forth, their median projection is to hit $31. So I'm going in line with the big banks and with the overall company that's spending a lot of money on their share buyback. And most importantly, I'm getting this stock at massive discount. Why wouldn't I want to be involved with Tencent Music? This opportunity was brought to you by FX Choice. I'm going to show you exactly how you can place this trade on their brokerage. Okay, so we are on FX Choice. We're on their brokerage and we are looking at Tencent Music. So for those that don't know how to find that on here, you go up to the new charts and you go down to shares and then you scroll down until you find it. So you've got like Apple, Amazon there, you've got Facebook, Microsoft, you've got all these different nice options that you can trade. And then when you scroll all the way down, you've got GlaxoSmithKline as well, and then you've got TME, which is Tencent Music. So we're going to be buying £10,000 worth of shares with FX choice, and we're going to be buying that on Tencent Music shares. You can see here that we have a huge upside potential of between 40 to 50% to the upside, because if we're buying around $18, $19, we could get this move going all the way back up to $30 to $31, which is a fantastic move. If you want to find out a little bit more as well about FX choice, click the link in the description and go check them out.